Okay, hello. I'm doing this video instead of the live session on a Friday because I just don't think I have to drive home and I just don't think I can make it before 7. So I'm making this video and I'll post a link on it a little bit later on today. So in week 3, we're covering cash and receivables. So I want to go over some of the topics that we cover with cash and receivables in this video. So we have different types of assets. You know, we have current assets, we have long-term assets, we have intangible assets, and then we also have what we call financial assets. And these financial assets include cash, short-term investments. So if a company has an investment like they own some shares of another company, so they could own shares of Baxter Company or they could own shares of Apple Company, and they intend to sell those shares within a year or less, those are considered to be short-term investments. So they plan to buy, hoping that the price will go up sufficiently over their view. So if their view is intended to be, when I say view, that's a period of time. So if the plan is to sell these investments within a year or an operating cycle, and I'll get to that when we talk about revenues, but if it's within a year, then those are going to be considered to be financial assets. And then the third one that we have here are receivables. So when a business sells an account, then the IOU that the customer signs will indicate that this is maybe a partial fulfillment of a bigger order, or it could be the completed order, but it results in a credit to sales and a debit to accounts receivable. And that debit to accounts receivable, or I shouldn't say just the debit, but the account itself is going to be a financial asset. And the reason being is that in about 30 days, give or take, depending upon the terms of their credit, that this receivable is due in the short term. And generally speaking, when we talk about accounts receivable and taxes receivable, there's going to be no interest that's involved. All right, now let's talk about how do we value these financial assets. And cash is on the books at its fair value. So we know that if we've got $1,000 of cash in the bank, then on the financial report, the balance sheet, we're going to record cash at its fair market value. Now, the next one that we have here are short-term investments. How do we value short-term investments? Well, short-term investments are also going to be recorded at their fair market value. And the assumption that we are making and maybe I should just label this one as fair value and this one as fair market value. Fair market value just means on the last day of the fiscal year, what was the closing price for these investments? So we assume that they had some Apple stock. We would want to go to the Apple website, or we want to go to some other place. You can go to, for example, sometimes the companies report the value of the share of their stock. We can go to Yahoo Finance, even Google Finance, and we would find the fair value, our fair market value. What was the last price it traded at during the fiscal year? And then next we have is accounts receivable. And accounts receivable are result from selling on credit. So the customers have promised you an IOU. But keep in mind that there are going to be some customers that don't pay. And the reason that they don't pay is, who knows, maybe they never intended to pay at all. Maybe it could be that they fell into some terrible financial problems, or the economy may have taken a terrible downturn. So with accounts receivable, we do not record them at the amount that the customer owes us, but rather we record them at the amount the customer owes us minus the estimated amount that we are not going to collect. So let me just repeat that. So for receivables, accounts receivable, we will report them at the amount that we expect to be able to collect. And that's always going to be less than the amount that is owed. So for example, if we have all of our customers and the customers owe us $100,000 in receivables, but we know that there is a chance that, let's say, 3% of those will not pay. So then if we record an asset of $100,000, the total amount that our customers owe, we may be overvaluing the receivable because we just know that some customers don't pay, but we don't know which customers don't pay. Otherwise, we either would not sell it to them or we would write them off directly. But at the end of the fiscal year, we need to estimate how much of these receivables we don't expect to receive from the customers. And so this is called net realizable value. Net realizable means how much of the full amount do they expect to realize or receive from those receivables. Okay, so cash on hand, cash in the bank, etc. How do we value and how do we manage cash? So please note that cash that's in the cash register, that is a part of cash. Cash that's in the bank, that is a part of cash and the checking accounts. And then if a business uses, for example, Visa, MasterCard, American Express, these types of credit cards, generally speaking, those credit cards pay out within a day or two, but they do subtract away their servicing fee. So if you bought, who knows what, a watch for $100 and you paid with your Visa card, then depending upon the arrangements that the retailer has with the Visa company, the Visa company is not going to pay 100%. They may pay 97%. They may pay 95% to the business. And then the 3% that the credit card company keeps, that's to cover their expenses. All right. And also the advantage to the seller or the retailer is they don't have to mess with establishing accounts, the billing of accounts. They don't have to worry about trying to hassle somebody to pay. All right. Now, how do we manage cash? And you know, cash is small, cash is desirable. So, how do we protect the cash? How do we manage the cash? And there's several points I'm listing here, but this is not a comprehensive list, but this is the list of the most common and the most highly recommended. All right, so number one is accurately accounting for cash. When we say accounting for cash, accurately recording when we receive cash, how much was received and how much was debited to the cash account. When we make payments, generally speaking, even though this is somewhat changing with the introduction of technology, payments were made using a check. And what happens is that check then goes to either the supplier or to an employee, like a paycheck, and the employee deposits it, and then going back into the old days, then the cleared check would come back to the bank, and that serves as evidence. The bank has their record, we have our record, and those two records should match. All right. Having certain controls in place to deter or minimize losses from embezzlement or fraud. And just to tell you a quick story here, I had a student one time, and her father had his own business, and he hired her as a receptionist / accountant. And my student's father's kind of assistant got sick, and she was sick for an extended period of time, well over a month. And while she was sick, my student's mother went in to help with the business, and she came to her husband, and the bank statement came, and she said, "But why are you using the business credit card to buy groceries and to buy pay the telephone bill and so forth like this?" And he didn't know what she was talking about. And come to find out that the lady who had been working in the business had been using, because she had access to the cash account, or the cash in the bank, and she was using it to pay off her cell phone bill. She was using it to pay for her groceries, pay for her gas, etc. And they found that over a short period of time, that this woman had stolen $50,000, and if she had not have gotten sick, they would not have discovered it for much longer. All right, now, another management technique that we have is to anticipate cash shortages. Now, what does that mean? Most businesses have some sort of a seasonal trend. I shouldn't even say most, many, let's say, have seasonal trends. So, for example, if you're in the card business, you know that a lot of Christmas cards are going to be purchased in the months leading up to December. Then there's probably a bunch near Mother's Day, and maybe a few less during Father's Day. These are the common times when people send cards. So, based upon that sort of seasonality in the sales, then cash management involves anticipating those, so we know when to borrow and we're ready for it. And then on the other hand, too, you can imagine that when during the season, there's going to be a lot of cash that's coming in. Cash that is just sitting around or sitting in a checking account really doesn't do much. And so therefore, when they have excess or extra cash, the goal then should be to invest it so that it brings a return. All right. What are some of the controls that we can do in order to minimize losses and minimize the pilfering or embezzlement, and also to maximize the likelihood that the records are correct, because we are all humans, and it is easy for humans to make a mistake that's not really trying to steal, it's just an error. All right, so we use cash registers for cash sales. The reason we use cash registers, and the beauty of it, is that cash register is keeping record of every transaction. So at the end of the day or the end of the shift, you know how much cash should be there. And then also the transactions from the cash register can go ahead and be then credited to the sales account. Remittance advices, EFT receipts, a voucher system, EFT payments, all of these are ways that we use to ensure that we preserve our cash. So a voucher system relates to when goods are purchased on a payable. So you have this voucher, and then you will have an invoice. So the voucher is a company issued document that says what they ordered from who, when it's supposed to be delivered, and how much you're supposed to pay for it. Then when the customer ships, not the customer, the supplier ships the goods, then he's going to have a bill of lading or some other documentation that's going to show what was agreed upon to be purchased and what is the purchase price for the various items. So the accountant needs to get those together. Here is the purchase order. We told them we wanted 700 of unit X. Then when they send the goods, they'll send a bill of lading that shows that what's in that package should be 700 of product X. Then, this is all part of the voucher system. The supplier will send an invoice, and the invoice will say you need to pay within 30 days. The goods are shipped, and those documents, especially the purchase order, is going to be used as documentation of support with the receiving order. So if we send an order for 700 and we receive 680, then we know that we need to contact the supplier because of this error. All right, so voucher system just means we're going to put all the documents, the document that we ordered, the document that we invoiced, the document that we received, and perhaps even others all together so that we know we should pay this bill because it is for stuff that we ordered and received. And so therefore then it gives a control over the cash receipts and disbursements. That's why we really discourage people from using cash. When you pay that invoice, you pay with a check. All right. Now, sometimes there is such a thing as cash over and short, excuse me. And when you're using a cash register, and according to the internal reports, you should have so much cash. There's so much also that's going to have been received through checks, and how much was received through use of debit or credit cards. All right, so the cash register drawer, it needs to add up. Now, generally speaking, when a cashier first gets the drawer, there may be $100 in tens, fives, ones, and coins. And so at the end of the day, the amount of the cash sales plus whatever was in that box, in the cash register box, should add up to the amount of the cash received plus the amount that was in the box to begin with. But it doesn't always happen because people make mistakes. So, for example, if the cashier gives too little change or too much change, and the cashier doesn't notice it, and sometimes the customer doesn't notice it and they go about their business, but at the end of the day, when you've got to balance out that cash drawer, there's going to be a difference. One time, and it was not too long ago, I purchased, I can't even remember what it was, something small, and the lady gave me back almost all the money I had given her. So if I gave her $10 and she was supposed to give me back $5 and some cents or $6 and some cents, what she did was she gave me two $5 bills and some cents. So I just looked at it and said, wait a minute, this doesn't look right. Oh my goodness, yes. She then corrected it. Keep in mind that the cashier is responsible for that cash box. So it's not uncommon that if the cash box is short, then the amount of the shortage is going to come from the pay of the cashier who is responsible for that box. All right, so let's just take a quick look here at an example. How do we do the accounting for this? Technically, like I said, and I believe the best way to do it is to hold the cashier responsible. But there are other ways of doing it. And one is we can use this cash or over and short account to absorb any shortness or any amounts that we're missing, or we can use it as an overage account where we had more in the box than we had receipts for. All right, so it says here, prepare the journal entry to record the shortage over. Well, let's take a look here. The cash register had $7,275.39. cents. And the total of cash sales in the register was $7,278.52. So as I've noted here, they're short. This is how much they have in the box. This is how much they should have. And they're short by $3.13. So then, what is going to be the journal entry to record? All right, so we have this cash short and over account. And so really what happens is this cash short and over account, we're going to have to add $3.13 back into the cash register so that when we reimburse it for the actual bills and whatnot that were paid out of the cash drawer, well, maybe there really shouldn't be some, but if you have petty cash, it's a different story. But so this shortage here is going to then be added into with the rest of the cash to get the balance where it should be. So we use this cash short and over account, and we would debit it for $3.13. And then where are we going? What are we going to credit? Well, we're going to take that cash right straight out of the cash account. And so it's going to transfer from the cash account in the bank into the, well, I shouldn't say, let me rephrase that. So then this cash would be added to the drawer and debited to this cash short and over. I don't particularly like using a cash short and over account because it gives too easy of a way for the cashier to be able to steal money. If it has to come out of their own pocket, we generally find out that the cashier is much more careful. All right. I'm not going to cover bank reconciliations today, and I'll have that up later. What we're going to cover right now is petty cash. All right. And petty cash is usually as a small amount that is kept on hand in the business, and that small amount is to cover for miscellaneous statements. So sometimes if we have to run down to the office supply store because we ran out of staples or ran out of photocopying paper, etc., that can be paid out of the petty cash fund. And when the cash is taken out and some other good is purchased, that receipt is going to be evidence that part of the money in the petty cash box was paid in order to acquire supplies that go along with the petty cash account. All right. Now, some of the internal controls. When you have a petty cash account, only one person should be the custodian. And the reason being is that if money shows up lost or missing, then there's no one else that was accessing that cash box. And so therefore the custodian would be the one that's responsible. Now, the reason I say that I'm not too keen on using this cash short and over account is the fact that it kind of instills a bit of laziness in the employee. The employee is no longer responsible for that cash as they were, or as they should be. Because if the cash is short, then that means that the customer has underpaid, and so therefore the custodian of the cash machine should be paying. Another important note to take is that every so often we need to replenish the petty cash box. Replenishing means that, after some time you've paid different expenses, so the cash has gone down, you have receipts for everything that you paid, but there's not very much cash left in the box. So therefore, we need to do a count of the cash and a totaling of the receipts And that should be equal to the amount that we had set into the cash box. And in this case here, let's see. Um, it says that they had a cash box of $250. So at any point in time, there should be cash and receipts that add up to $250. All right. And then another thing that we want to note is there is an account called petty cash. Petty cash is that account where there's some few dollars in the office in order to pay for any sudden or expected losses. And when there is a petty cash fund replacement, please note that we do not debit the petty cash account. What we're going to do is debit cash, because all that's really happening is instead of having the cash in the bank, the cash is usually in a lockbox in the office. So every time that we replenish a cash box, so if we had trying to think of something. Let's say that they paid for the newspaper subscription on the 15th of the month. Then there needs to be in that cash box less $15 plus a $15 receipt. Okay, so here we go. Blue Waters Company established a petty cash box in the amount of $250 on the 1st of November 2010. During the month, the custodian dispersed the following amounts from the petty cash fund. So there was a bottle of water that was delivered, and it cost $32.50. They used some office supplies, or they acquired some for $47.43. There was some postage. For that one, it says here debit postage expense, and that's $10.65. And then there were supplies for the office party, and they paid $138.79. All right. Now, at the time that the fund was replenished, there was $20.88 in the box. But let's just take a look here. If we add up the expenses, $32.50, $47.43, $10.45, and $138.97, we come up with $229 and 37 cents. All right, so that's what's in the box. And then, those receipts, and then there's cash in the box, and they tell us that $20.28 of cash is in the box. So technically, when we add these two together, they should add up to $250, which is the original amount of the cash box. But instead, they have more money. So what that means is we're not going to we're not going to take the money out of the box. Rather, what we're going to do is replenish it for an amount that's a bit lower. So in this case here, the first thing that we're going to do is to record the establishment or the creation of the box. And they tell us here that on the 1st of November 2010, that they established this petty cash box. So we're going to debit cash for $250 and we're going to debit petty cash, petty cash. All right, when you see petty cash, you know that's a cash amount on a book that's fairly close by. And so petty cash, that's the amount that we're going to put into the cash box, and then we're going to credit cash. Generally speaking, they will issue a check for the amount of either what's put into the cash petty box account, or if we increase the balance. Because sometimes what we can see is, you know what, we're replenishing this once a month and it's not sufficient cash for all the bills. So maybe what we ought to do is look at the other side, which is, I lost my train of thought just there. But anyway, the point I'm trying to say is When we replenish the petty cash fund, we're going to replenish it based upon what is the amount needed. And so we're going to debit the expenses. We're going to credit the cash account so that when we replenish, this is a cash the check and put it into the petty cash box, it needs to be $250. All right, now, so there was $20.88 in the box. So we need to replenish for $229.12. All right, but we had these expenses. So just a minute. All right. Okay, so what I have here now is these are the receipts that are in the cash box, and there was 20. Let's see, what was the amount? $20.88 was in the box, and when we added what was in the box with the receipts, it should equal to $250. But what we see now, it really equals to $250.25. So we're actually over in this case, and when we're over, we're going to actually credit the cash account. But let me show you how we do this. So on the 30th of November, they will prepare the journal entry so that they can cut a check in order to be able to replenish the box. All right, so they tell us the various expenses. Well, they bought bottled water. It says debit, office, supplies, expense, and that was $32.50. Then the next one says that they had office supplies, and those office supplies were $47.43. Then there was some postage that they had to pay. All right, so we'll have here postage expense. I'm sorry, not also going to be the 30th of November. All right, so we're going to have postage expense. Whoops, what am I doing here? Excuse me. Sorry. You can probably tell I'm a little bit tired. All right. So we have postage expense, and the postage expense was $10.65. And finally, we have the supplies for the office party, and they said to debit entertainment expense. And that was $138.79. Now recall that to replenish the petty cash box, we're going to need, in order to get it up to 225, is what I want to say is we're going to need to replenish it. There's already $20.88. We're going to need to replenish it by $229.12. But keep in mind, there's already 25 cents too much in this account. All right, so I'm going to skip a line here, and I'm going to debit cash short and over. Cash short and over. Okay. All right, and the cash short and over, we know that that's going to be 0.25 because that's what we calculated here. And then we need to write a check for cash that will cover um, the amount that's needed to put back into the petty cash box, and we computed that to be 229.12. So 229.12. All right. Now the next question says, well, let's say that we figured out that the amount that we have in the cash box is less than what we really would need. So let's increase it. And let me see here. Instructions tell us, no, they don't tell us anything. So when we look at this, increasing the cash fund, it says that they decided to increase the petty cash fund to $300. So this is the only time when we're either increasing or decreasing the overall amount in the petty cash box that we are going to use the petty cash account. So we use the petty cash account when we establish the petty cash fund, when we increase the balance of the cash fund, or if we decrease the balance. All right, so assume that they decided to increase. So we're going to debit petty cash. And it says here that they wanted it to be $300 already. If we go back to the beginning of this problem, okay, that's where I'm going to stop for this video right now. And at least to kind of get you familiarized with the cash ones. As I said before, I doubt it I'm going to be able to get back in time, so that's why I'm making this available now. And next week I am in conferences from 8 in the morning till 9 at night, so I'm going to try and be checking your email either early in the morning or late in the evening. Okay, that's it for cash and receivables.